we're going to talk about just selling premium as basic calls and puts in this session. But as we build up, what we learned today is going to help us for the next session when we start talking about vertical spreads and then horizontal spreads and then diagonal spreads and then multi-leg. So all of this is going to build up together. So if you're like, oh, I can't afford this, the kinds of trades that she's explaining, these don't make, sense for a portfolio of my size, give me time and I will make sure. There's spreads that you can trade for as little as like $20. So we just have to get there. So just, stick with me. I highly, highly, highly encourage questions. And, I'm just here to help. So there's no such thing as a dumb question. Don't ever feel like, oh my God, I can't ask this. You're going to have to rewire your brains with the stuff that we're going to talk about over these next 60 minutes. So just, give yourself the chance to win. And with that, I'm going to share my screen. I think we're going to get infinity screen for a split second. So sorry in advance, but let me know. Un momento, por favor. Can you guys see my my slideshow here?
Yes.
All right, cool. Ways to collect premium. Awesome. Okay, so we are talking about the wheel strategy today, also known as a way to collect premium. So without any further ado, let's start from the top. So anytime that people start discussing selling premium, you usually hear them talking about selling covered calls, right? And a lot of you are like, well, yeah, but what the hell is a covered call? And essentially, a covered call is a trading strategy where you, as the owner of 100 shares of any underlying stock, are able to write contracts and collect premium. When you write an option contract or sell premium, those are synonymous terms for selling to open. So I'm teaching this with the assumption that you guys are familiar with how the Greeks work, and you're familiar with how open interest and things like that work. So if you don't know, I can always, blaze through it 50,000 foot view. But when you write a contract, right, the signs on all of your Greeks flip because you are a seller. And we know that options are a zero-sum game. Okay, so when you have 100 shares of a company, you can write calls and you can create money from simply owning those shares. And that's really the true power of holding shares of stock, right? Not only voting rights, but also to be able to create passive income, right? And so a lot of people, after they figure out, oh, you can write an option contract, they're like, but, why would I do that? Because I've heard that you can lose, infinity dollars whenever you write or sell to open a call just willy-nilly. And while under normal circumstances that would be true, remember, this is a covered call. So we're not doing anything naked. Nothing that I'm going to teach you about ever is going to be doing it naked. Boss. But you know what I'm saying? We're covering our position either with cash or with shares. So that's where we're coming from. That's a standpoint that we're going to take here. So remember, we own 100 shares of the stock. We're not going to be writing naked calls, and we're definitely not going to be writing any naked puts throughout this entire endeavor. So let's take this a step further. Why would somebody ever want to write a covered call, right? Well, short answer, people enjoy selling covered calls because it's giving them downside protection to their portfolio's shares. Okay, so when you sell to open a call, remember how I told you earlier that the signs on all of your Greeks flip? Well, selling a call is a bearish prediction on the stock's share price, right? Or what the price action of the stock is going to do. So think of it. Let's go back to that example of the zero-sum game where there's a buyer and a seller. They're taking opposite positions. When someone sells you that call, they're basically saying, we're not going to go up over this strike here. So whatever, if it was the 25 strike call that they sold, they're essentially saying, I believe that the stock is going to be below 25, probably more like 24 at expiration. And if they're correct, they get 100% of the premium that you just paid them. And if they're incorrect, then they're going to be losing whatever the amount is that you're up on that position at expiration. But that's a little bit deeper than where we're going right here. So let me get back on track. So essentially what you need to understand is when you sell a call, it's a bearish prediction on the stock's price action, and you're hoping that your position expires out of the money. So if you're the kind of person where every time that you're buying an option, it's ending up expiring worthless, you might just be a really phenomenal option seller and less of an option buyer. There's something for everybody out here. So if we own 100 shares of the stock and the stock is dropping in price, we're going to be losing money on our shares, right? Every dollar that the stock goes down, if you got 100 shares, you're losing $100. that kind of bites, right? You don't really want to see that on your portfolio. And there's ways to mitigate that. And the covered call is the way that we can mitigate it, because if we're selling to open a call, that call is going to pay us money to the downside from its shrinking delta and its growing theta. So put a pin in this idea for a second. Whenever you become a seller and the signs on all of your Greeks flip, right? For your calls, it's going to act the same way that a put delta would, right? It's got a negative sign in the front. So you are essentially going to be collecting whatever your delta is in premium for that first dollar. And then, you know, obviously your gamma is going to pull away from the size of your delta, and then it's going to shrink your delta away to nothing. At the same time, anytime that you sell to open a call or a put, anytime that you're a seller, period, the reward for selling options is theta decay. You get paid in theta. So no longer is your theta a negative sign. Every single day that passes, because time is passing, you are going to get paid in theta decay. So yet another reason why I'm trying to evangelize people on, you know, selling options, because it's one thing whenever you're, you know, fighting a $400 theta, but it's another thing whenever you're getting paid a $400 theta. It feels really good. So for sellers, we'll collect the value of the contracts theta decay each day, right? And actually, we're going to profit as we get closer and closer to expiration. So one of the concepts that we're going to keep revisiting throughout not only this slideshow, but through the future, you know, weeks and months that I'm teaching this stuff is we do not experience max gain or max loss until expiration. So if you're, you know, busy and you have to step away from your computer, you're not going to hit, unless the market does something that's completely out of left field, right? And has like a 2 or 3 standard deviation event that happens and sustains, your position is going to be just fine. It's going to pull back. It's going to recover. It's going to pull back. It's going to recover. But time is on your side, right? So that's the real benefit here. Our delta, like I said earlier, is also going to pay us as it shrinks, because we want our position to be pushed further and further out of the money. And we understand that the further out of the money that we get on our option, our delta is going to shrink, and it approaches 0 until it gets to that asymptote, right? And once it gets to that point, you've probably collected 100% of the premium. But this means essentially that the buyer of that option that we sold is going to be losing money, and we're collecting their premium as the stock share price begins to drop. Another reason that people really enjoy selling covered calls is because it does this thing called reduce your cost basis. So for those of you who are kind of newer to the game, your cost basis, I have the Investopedia definition up here, but it's really just nerd talk for saying how much you paid for it. What did you pay plus any commissions and fees that you had to stack on top of it? If you paid $100 plus $5 in commissions and fees, your cost basis is $105. That simple. But, you know, for the people who want the nerd talk definition, at its most basic level, it's the total amount originally invested plus any commissions or fees involved in the purchase. This can either be described in terms of the dollar amount of the investment or the effective per share price paid for the investment. So, you know, this example here at the bottom, think about it like this, right? You buy 100 shares at $10 a pop, then your cost basis is $1,000 in total. And let's say that you sold an out of the money covered call with a 30 delta, right? An out of the money covered call, just let's say that was worth $30 in premium, you would reduce your actual cost basis down from $1,000 to $970. So we know that there's expirations for some underlines. It's like every other day, but for most it's every week, right? So what we can do is we can say, well, first week it might be 970. The next week we might reduce it down to 940. The next week after that, maybe it's 900. And we just keep doing that over and over and over and over again. So this is super great for the people who are leaps buyers. I got a little something for you when we get to the diagonal spreads. But let's continue, right? Covered calls. So how can I see my cost basis? This is a super old example from way back in my college trading days. So essentially your cost basis, it's going to be just your average cost, whatever you paid in. If it's a commission-free platform, I don't think Robinhood is anymore. But I know like Fidelity that I use now, it isn't. So you're going to also make sure you factor in however much you had to pay in your commissions. And it should show whenever you're looking at your account overview right there in the average cost. And it'll include the price with the commissions, typically, how much you paid for it. So in this example, if I had purchased 100 shares of Apple instead of just like 2 and then it split. This was before their split in the summer of, I think, 21. My cost basis would have been $11,265, right? If I would have bought 100 shares at the current price that I took this picture, it would have been worth $13,546. And this is just fractal for any underlying. That's how you can effectively look at your cost basis and know how much money you've come out of pocket. So let's continue with an example here and keep this going. If we own 100 shares of a stock, right, that is the same as saying that our delta is equal to 1. I hope that makes sense, right? If you have 100 shares of stock, the stock goes up $1, you make $100. Is that not the same thing as having, if your delta was 1 or 100, stock goes up $1, you make $100. It's the same thing, right? So let's just use that. Keep that in mind for this example here. So if we sold an out of the money call with a 0.3 or a 30 delta, we're hedging our shares in case of a bearish stock move, right? Because we want this to be out of the money at expiration, meaning that we have reduced a portion of our downside exposure. So in the example to my left here, you can see that as the stock is falling, we're going to take in $28 worth of gains for that first dollar decline in the stock share price. Why is that? Because our delta is 0.2885. So, we move that decimal to the right twice, 28.85. So we're going to make just under $29 if the stock drops $1. And this was back when NEO was like $70. So that's how you know this was a long time ago. But the concept is still the same here, right? So then, of course, our gamma would pull away from our delta because we're going further out of the money. So now we would go down from 28 to about 25 on our delta, and then rinse and repeat, rinse and repeat, rinse and repeat until our delta has rendered away to nothingness, and we can skip off into the sunset and pick out our Rolls Royce interiors, right? Because we're making money. So for regular shareholders, if the stock went down $1 and they had 100 shares, they're going to lose $100. But for you, right, because you are super smart and you were like, no, I see, I'm going to go ahead and sell this little 0.28, basically a 0.3 delta here, you're going to be able to collect that $28 and you're only going to be out of pocket $72 instead of the full 100. This concept is fractal, right? Imagine if instead of it being, $100, it was $10,000 or $100,000. Plenty of people do this every single day to hedge their portfolio. So I don't know if this is typical or if anybody usually does this, but I want to open up the floor because I know I just yapped about a lot of different concepts and I don't want to go too quick through it, but I want to make sure we can get through this slideshow. Does anybody have any questions about anything so far? Thanks. Thanks, man. Bring it. Nobody?
I have
Yeah.
a question.
All right. What's up?
The question is, so when you profit, you're saying when you profit on the premiums and stuff, the position has to still go your way, correct? Like in the direction of what you're picking, like the vertical spread or whatever you're going to do, right?
You literally read my mind because the next words out of my mouth was going to be this strategy, selling calls, selling puts, period. You'll hear people talk about them being, so for selling calls, for example, bearish to neutral. The cool thing about this is as long as your strike isn't in the money, you're going to be able to hit 100% profit, like period, because of theta decay. Because theta is on your side, even if the market chops and it's not moving in any direction, you know how people are like, oh, market goes up, down, or sideways, and people are only trading calls and puts as buyers. Well, you're only going to be able to profit, what I'm saying statistically, 66% of the time? This is that other little 33%, dude. This is whenever there's like no movement in the market and you're just sitting there out of the money and those premiums are, being absolutely destroyed by theta and vega, that's going to you as the option seller. So it doesn't matter as long as if it moves in your favor, you're just getting paid faster. But if it doesn't move in your favor, you just got to wait for theta to catch up. So when we start talking about expirations a little bit further in this slideshow, you're going to be like, oh, okay, cool. So this much time. And, by the time that it's a weekly, you're collecting hand over fist. And by the time that Thursday hits, things are looking pretty sexy, or maybe not if it's not in your favor, but you'll be able to cut it because you'll see that.
Okay.
Yeah, man. Yeah, no problem. Anybody else?
Can you guys hear me?
Oh, I can hear you. Oh.
Yes, I have a question. Will you guys cover also naked puts? Because for me, it sounds like naked. The whole strategy starts with naked puts, then you get assigned, and after that, you sell covered calls.
That's exactly what we're going to talk about next, actually. So I always start from the call perspective because usually a lot of people, number one, they have a little bit of an issue being able to understand what out of the money and in the money looks like for puts versus calls. They're trading calls all day. But yes, that's literally in the next, I think the very next slide. There you go, cash secured puts. So before I keep going, anybody else? Speak now, forever hold your peace.
Is it possible to get more profit?
More profit from selling your call?
Yeah.
So I mean, absolutely. There's a million different ways that you can collect premium when we start talking about like iron flies, iron condors, the whole 9 yards. Like of course, yeah. But for this example, this is pretty basic, and it's just the wheel, selling calls, selling puts, just laying the foundation. But once we start talking about multi-legs, that's when we'll be able to start talking about receiving, a $6,000, an $8,000 credit, a $2,000 credit, an $800 credit, things like that. So yes, short answer, yes. Long answer, it's going to be quite a talk for that one.
Can I maybe ask him a question? Beckham, did you mean that, you know how the upside for a single call that you purchase has infinite upside, but was your question related to selling a call, for example, having limited or unlimited downside? Is that what you meant, or other strategies? Beckham.
No, I figured it was just a set amount. I just wanted to make sure I had it right.
Okay.
Definitely. So whatever I should have definitely prefaced that. So whatever your credit is that you lock in, you're stuck there. That's as much money as you're going to make point blank period. So this was one part of a spread that I was in. This wasn't, I did not tie up $7,000 to make $115. That would be absurd. But whatever your average credit is, once you lock it in, that's it, period. So if this thing shot up to being worth, $957, then, your girl's up the creek with no paddle. I will be down several $100 and it would be quite a pain. But yeah, that was a great question. All right, so let's talk about the put side, and then let's really get this wheel idea all the way together. So anytime that I say, hey, what about cash secured puts? People are like, what the hell is a cash secured put? That sounds complicated. It's really not. A cash secured put is essentially just nerd talk for locking in a price to purchase 100 shares and receiving money to do so. So like being paid to wait. So in order for you to trade a cash secured put, you must have the collateral or the cash, right? Those are interchangeable terms, to purchase the shares before you sell to open the position. Like that is key. If you remember nothing else about cash secured puts. And remember, as a seller, we have the obligation to do something depending on the type of option that we're selling. In this example, it's puts. So we are obligated to buy someone's shares. But if it was a call that we were selling, we would be obligated to sell 100 shares, right? So when we sell a cash secured put, there's only one of two things that can occur. And they are either scenario one, right? Our cash secured put expires out of the money, and we will get to collect the premium of that contract and carry on our merry way, right? The contract expires worthless, so therefore we have no obligation or liabilities upon expiration of that contract. Or scenario number two, if the put expires in the money, meaning that our strike is greater than the price of shares, right? We're forced or obligated, I didn't want to say forced, that sounds kind of brutal, to buy our 100 shares at our strike price, which is more expensive than the current market price of shares, which is ultimately going to result in a net loss on the position if and only if, this is under the assumption that we haven't been collecting premium beforehand. So this will make a lot more sense once I show you the diagram of the wheel, but stay with me here. So scenario number one is ideal. We collect, say we sell a cash secured put, they pay us $100 in premium for that option contract that we just wrote, and a week goes by and it expires out of the money. We made $100. We can do the same thing over again. We could choose the same strike or a different strike. It's up to you, depends on the price action. But we can do that over and over and over and over again until eventually we're going to get assigned and we're going to have to pick up those shares at the strike price that we chose, right? So let's talk benefits and drawbacks of cash secured puts. Benefit number one, you get to collect premium while you're waiting for the entry that you wanted at the price that you wanted for whatever the underlying is, right? Number two, if you're a fill, you'll own 100 shares of a company that you enjoy. You'll click your heels. You'll be super pumped. Everything is gravy, right? But of course, with anything that has benefits, there's always drawbacks. So drawback number one, right? Of course, if you get assigned the 100 shares, that means your contract is in the money and you're buying shares at a higher than market value price. So if shares are trading at $100 and you had to pick them up at 110, that kind of sucks, right? You could have got them at 100 on the actual market, but instead, you had your put position that you sold. You feel confident. You're like, if you liked it at 110, you're going to love it at 100, right? So you're going to sit there and you're going to have your shares, right? With a smile on your face, hopefully. And then, of course, drawback number two, you have to have the collateral in order to sell to open just your own cash secured put, right? If you don't have the cash reserves to fork up as collateral, you can't sell the cash secured put. However, when we start talking about put spreads, you're going to have the money to be able to get into them. But for now, I want you to just think of this as purely cash secured. So if the shares are trading at $70, then that means you're going to have $7,000 in collateral for whatever that option contract is. Kind of steep. So I know that was really brief. I know that was really quick, but these next few slides, I'm going to go all the way through this entire process. So from the cash secured put all the way through to the covered call, and then it should bring everything all the way together. Does anybody have any questions about cash secured puts, though, before I go forward? Yeah. Mm-hmm. Yep. Yeah, so essentially your brokerage is going to set it aside as collateral. Like it depends on the brokerage, but you'll see it just off to the side. You won't be able to use it for anything else. They're holding that money just so that way, in the event that you do get assigned, you already have the cash right there. It executes it automatically for you. And next thing you know, the next market open, you will see those shares appear in your account. So yeah, that's the collateral, is just them holding aside that money. And whatever that credit is, whether it's, you selling a call or a put, this goes either way, that credit is going to get deposited into your cash balance the moment that you open up that position. So that credit goes into your cash balance. That collateral is taken out of your cash balance. So everything will look a little bit wonky. You're going to try to do the math. Just take whatever it was that you're credited, plug that in and subtract out whatever the collateral is, or basically your strike price times 100. And that's how much will be set aside.
I'm going to add something. Earlier you said I'm not locking up about 7,000 or something. That's absurd. Can you elaborate more on that? Because I think in that example, is it because you are choosing the ideal strikes, or I don't know, like delta ratio to make sure you're not locking up too much money where it's not worth your investment any time? Is that?
Absolutely. So whenever I said 7,000, right? So in this example, this was, like I said, part of a vertical spread that I had entered into. But $7,000 is quite a bit of premium or quite a bit of money to lock up for $115 worth of premium. Typically, there's a saying in the option selling community that you don't want to collect pennies in front of a steamroller. And when we talk about, our Greeks and the deltas that we want to sell around, we understand, right, when we started learning about Greeks, that delta, a lot of traders will use delta as a probability of making it in the money at expiration. So when you start talking to the guys that, they're doing the Black-Scholes model and they're doing all this crazy mathematics, they're using that delta as a probability. So in this example, when I sold this option to somebody, they had a 28.85% chance of success, right, of making it into the money at expiration. Whereas me as the seller, right, I had a 72 or 71% probability of success. So whenever I'm looking to sell options, I really like to go for that like 25, maybe 30 to 20, really. That 20 is about as low as I like to go. When you start talking about a 15 delta, you're tying up, you know what I'm saying, $7,000 for maybe $75 credit instead, or, you know, $60,000 for $70 of credit. It's just not worth it. You could put that money to work better just trading options somewhere else, or just opening up a vertical spread, unless you really, really, really want the shares and the premium doesn't matter to you. There's a better risk reward ratio. You don't want to be caught collecting pennies in front of the steamroller, meaning you don't want to be, you know, ooh, this is a 90% probability trade, I'm going to take it because the market needs her pound of flesh. You could win on the 90% probability trade, you know, 68 times in a row and feel like the smartest investor ever. But when you take that first loss, you haven't made enough money to even recover. So then you're automatically one loss and you're in the hole. So there's like, it's less of a science and more of an art, right? Being able to determine what makes sense for you. For me, if I got $7,000, I'm going to freak it and do something else with it. And, you know, I'll maybe put $500 of my money towards collecting premium for NEO, but that's just my personal preference, if that makes sense.
I have a quick question.
Yeah.
At any point before expiration, you can get assigned if the contract goes in the money for either the covered call or the secured put, right?
So no, but yeah. So the only scenario where you could be assigned early that makes sense is if you're selling around an ex-dividend date, which is like a big no-no, right? Because remember, it's the same way whenever we started learning about buying options. You have that extrinsic value, right? That time value that's still left over. When you're around an ex-dividend date, if the amount of extrinsic value that's left in that position is outweighed by the dividend that they're going to collect, that's the only situation or the only scenario that really makes sense for early assignment. So I've had it happen only once to me, and I've been selling for like 4 years now. It's really rare, but that's traditionally the only time that you really have to be mindful of an early assignment whenever that extrinsic value is being outweighed by the dividend that's collected. Maybe somebody would exercise it early, but really, you know, I personally, once I see that I'm up, you know, 70 to 80%, I'm willing to let it go. Because think about it, right? We got $7,000 tied up here. I only have maybe like $60 more that I can collect. I like in this scenario, you have to understand when you've already won, right? When you're up 80% and you only have $12 worth of the credit left, like unless you're just trying to hold it for the pretty screenshot, which I wouldn't advise, just go ahead and close it out. You won. But yeah, early assignment isn't something that traditionally happens, at least not in my experience or any of the people that I've talked to, unless that ex-dividend date is coming around. Because they don't want to give up that extrinsic value, right? They would just be throwing money out of their wallet. That was a great question.
I have a question about closing it out. As you mentioned that, does it close out when the buyer sells, or can you close it out before the buyer sells? I guess I'm trying to understand how you get out of it.
Yeah, that's a great question. So buy orders and sell orders go together like a lock and a key. So in this example, we sold to open. So the only way to close it is to buy it back to close. So in this example, we received $115 in credit, right? So somebody handed us $115. Now it's worth 57, and we've so far collected 58. We would take from this $115 of credit the $57 that's left over and just buy it back to close, and we would profit the difference, which would be $58 right there. So just like whenever you buy to open a call, you have to sell it to close. If you sell to open, you have to buy to close.
I see. Okay. Thank you.
And and you can sell if, let's just say in this example, the market just swan dived off a cliff out of nowhere. And you know, this position went up 80% in the first hour and a half that you had it open. You can sell it you can buy it back to close immediately. You're not tied down to the person who purchased it from you, because right, they could, you know, go and close out their position and somebody else has the option, right? they're holding on to it, hoping it goes up, but it's not. So they might sell it off to somebody else. And that's what's creating the volume that you see each day, right? So when you see that the volume is super high on an option, for the people who are, momentum traders, they're looking for high volume relative to the open interest. That's what's happening. It's just people that are buyers that went in, bought, sold to somebody else that bought it, and it's going on and on and on and on and on. And until somebody decides to exercise the position, the open interest is going to remain the same. So yeah, hope that makes sense.
Does. Thank you.
Yeah, of course, of course. Anybody else? These are great questions, y'all. All right. Oh, did somebody else have a question? Yeah. Mm-hmm. 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 I would say like halfway, yeah, because right, we're trying to maximize our gains as buyers. We want to get that nice large delta move. But as sellers, we're hedging. We're hoping at expiration that our position is out of the money. And so when I'm looking at it, I'm trying to say, okay, based off of price action, and my delta changes, you're like, oh, well, why is it between, 0.2 and 0.3? Well, I can get a little bit more juice for the squeeze, right, with a larger delta and take on a little bit more risk. But really, it's just all about risk management. And so depending on what we see on the chart, and the strat is super great. Like, that's why I'm trying to learn this so much, because depending on if we're at a support level or a resistance level, that's going to kind of, and depending on what time frame we're trying to use in these trades, that's going to kind of affect our risk profile, right? We don't want to have something that's super risky and have it out there for a long time. So we wouldn't want to sell something with like a 60 delta, for a month and a half. It's a weighted coin toss against you in that scenario. So, it's kind of, yeah, I think that's a good way to look at it, but also just consider that when you're a seller, you're considering the risks associated with it, because you're locking in whatever that premium is. You're stuck there. So you have to look at that and say, okay, well, I can collect $300 here and I have a 70% win rate or 70% probability of winning here. Does it look like it's worth it? Is the chart saying it's going to chop around here, or is it going to move explosively in my favor? Great. Mm-hmm.
Basically, at the beginning of the week, you're not looking for, like, for example, the market just opened. Obviously, the values change or update
Mm-hmm.
the delta and everything. And so right now, you're not looking to sell something by Friday at the money. The people that are buying have typically 50 delta at the money. And if you are trying to do that same strike, the odds are against you as a seller. But you want the odds for you, and you go further out of the money for the people that may not get the move in that sense. And so you're trying to get something below 30, but not too much, because it's not worth the amount that you're locking up.
Beautifully. I couldn't have said it better myself, to be honest. Yeah.
No, I mean, you said, I guess I guess pieced it, but like, that's obviously, I've done spreads a lot, like before in 2021 specifically, but I just wanted to emphasize that, because I've seen a lot of people ask me that question of like, or I see people bring up some spreads that are not worth the RR, or either by time or capital in that sense, and that's where obviously like the most emphasis should be for them before opening any risk, to assess it on their own and determine if it's good. If they need help, obviously they can ask, but that's all. Sorry about that. Yeah.
No, please do not apologize, because that's actually back whenever I was doing a lot more teaching about this same topic, that was always something that I would see. A lot of people who would open up a trade and they're like, well, it has a 50 delta, so I figured it's like a coin toss. And I'm like, it is, but you have to factor in a lot of different things. It's not just, you can't just look at your delta and then just go for the gusto. Like, if you're selling right into a move that's going to go against you, you're going to get clapped very quickly. And it's it's ugly. It's really rough. And if you can have to sit in that position for a little while. And that's why I say it's an art more so than a science, because we know from the Greeks lessons, right, that theta begins to pick up its decay around 30 to 45 DTE, right, days to expiration. And then by the time that it hits weekly, that's when, things go parabolic and it really starts dumping that extrinsic value into your total return, right? So just that's definitely a question I get all the time. And I think that was very succinct. You did an amazing job explaining that. I love that.
Thank you.
Yeah, of course. Of course. So we talked about cash secured puts. I don't know if anybody has any other questions. Speak now, forever hold your peace. All right.
Maybe later afterwards. The idea of the open interest versus volume. It's been a while for me, so it would actually be a good refresher for me.
Absolutely.
But cool. Thank you.
Yeah, absolutely. Actually, I want to kind of talk about that right now real quick. So essentially, when I was referencing volume and open interest, right, we know that volume is the number of times that an option contract has been exchanged on the day, and that resets to 0 at market open every single day, right? So whenever you have people that are scanning and they're like, oh, there's a lot of activity at the Apple 185 call, they're essentially just tracking the volume relative to the open interest. So why would that be something that people want to track? Well, we know that open interest is the number of sellers that exist, the number of contracts that are out there floating in ether. So if there's 300 contracts floating in ether, but the contracts have been exchanged 120,000 times, something is going on, right? There's some crazy volatility with that underlying, and people want to see what's up, right? They want to be able to get that money, that quick money. There's a lot of scalpers that are hopping in there and riding this momentum. So when I'm mentioning, volume and open interest, the ratio between the two, if there's a super low open interest, or maybe even if there's kind of like a higher open interest, right? Maybe there's 20,000 contracts that are outstanding, and 150,000 people have exchanged it on the day. Just depending on the spread or the discrepancy between those two numbers, that's going to attract people's eyes and it's going to pop up on scanners. So that's volume and open interest, and I just look at those things. Sometimes bar chart, it used to be free. I haven't used it in years now, but bar chart had a really great scanner that the first hour of market open, if you just track that thing, you could see what was popping off in real time. So yeah, volume and open interest, super important. Yeah, super important, especially as a seller too. You're adding, anytime you sell to open, you're adding to that open interest. And the only way that open interest will change, right? Because open interest is going to stay the same, or it'll grow depending on if somebody sells to open a new position, right? So if you're tracking the open interest day to day or week to week, you might notice, hey, it's a bit larger, or hey, it's a bit smaller. The only way it's changing is if somebody is exercising their option, or if somebody is selling to open a new option. That's the only way that new contracts are birthed or destroyed. But yeah, carrying this idea forward, right? What if we could use a strategy that allows us to still potentially benefit after we sold that put, and we know that we bought them at a more expensive price than the market is actually offering those shares? What if there was a way for us to be able to make that money back, or to be able to even make more money on this position? This is the wheel strategy. All of my yapping has culminated to this phenomenal moment where we will talk about the wheel in full. So the purpose of the wheel is to collect as much premium as possible without assignment. If you are like a premium collecting ninja, and you got that feel, and you're able to collect and collect and collect and collect, it can build a medium-sized portfolio quite quickly. The wheel strategy, as we know it, consists of a few easy key parts, and I've broken it down step by step for you guys, so that way it takes some of the guesswork out of what you got to do. So step 1, the most important step, arguably, find a stock that you would not mind owning 100 shares of, and that you could, with your current cash balance, afford to buy outright, right? Think of sectors that have long-term bullish potential. I'm kicking myself now because there was a time back in the day where I was running the wheel on Marathon and on Riot, and I I missed the move, the big move. But imagine having 100 shares and you're just watching this, this crypto related ticker go wild. You don't have to have a huge portfolio. I think I only needed at one point it was only like $1,000, $900. It was great, right? That's would have been perfect. It was my go-to for the wheel strategy when I was a small port warrior. Step 2 though, once you found your ticker, you want to sell to open an out of the money put with a roughly 0.3, you could go all the way down to 0.2. Once you get into that 0.15, like I said, is the juice worth the squeeze? That's for you to determine, not for me. But you want to make sure you get it about 30 to 45 days from expiration because we want to take advantage of that uptick in theta decay. We will sell these plays because, like I said, theta decay increases on that final month to month and a half around expiration, and that's going to funnel the premium into our pockets even faster than just the delta alone. Remember, as this stock moves up, it pushes us further out of the money and our delta gets smaller. Selling to open a put is a bullish position, right? So directionally speaking, delta-wise, selling a put and buying a call are both directional equivalents to some degree. Obviously, it's a little bit different because with the put, your delta is going to be shrinking, so it's less and less and less dependent on the delta versus buying a call. Your delta would be growing, and it would be more and more and more dependent on the direction. But directionally, they're equivalent to some degree. So when you sell that 0.3 delta, that is going to imply for you a 70% chance that this position is going to expire out of the money, thus giving us a profit. So you take this trade 10 times, you're going to hit 7 out of those 10, statistically speaking. Not because I feel like it, literally numbers, like actual statistics, you have a 70% chance. Step 3, right? We talked about step 1, we're finding the stock. Step 2, we're figuring out our strike. Now, step 3, we're going to go ahead and sell it. And only one of these 2 scenarios can happen. Scenario number 1 is we avoid assignment because the delta on our option that we chose was 0.3. And we know that delta represents the probability of it making its way into the money by expiration. We're hoping that buyers take this low probability trade and they just degen their whole portfolio into it. And we just collect that premium, pick out Rolls-Royce interiors, and we eat a really big, thick tomahawk steak on a brontosaurus bone for dinner. We love it. Each time that the contract we sold expires worthless, we collect that premium free and clear. And, like I said, we go to the beach. We have a good time. Or scenario number 2, the dreaded assignment. The first thing that you got to do is, unclench everything, breathe. It's okay. Remember in step 1, I told you wanted to pick a stock that you actually wouldn't mind owning 100 shares of. Well, guess what? You got it. You got them. So just go ahead, breathe a little bit. We got to figure out what to do next, right? So if you were assigned, that means, a few things could have happened here, right? So let's go through these different scenarios. A, your put that you sold expired in the money and the shares are currently trading at a better deal than the price you agreed, which is what we kind of discussed. That's what in the money for a put would be, right? As a seller. And you got to pay. You're obligated, so you got to pay for them. So in this example, my God, the good old days back when Neo was $60 a pop, this would be like having the $61 put, right? You're picking up shares and spending $6,100, but if you had just bought them at market value, you could have bought them for $6,010. So net, you're looking at a loss of $90, right? And I'm just using this example without, saying, oh, we collected premium for 4 months beforehand. But if you did collect premium beforehand, you might actually have been able to outpace the size of your loss and still be up in the position. So the wheel is just a beautiful thing. But this is scenario 1, right? Picking up shares at a more expensive price than what it's trading out on the market and being like, you know what? I'm going to thug it out. It's cool. I liked it at 61. I love it at 60. Or B, I don't know who asked that question, but that was an amazing question about, well, what about early assignment here? What could happen? You're selling close to your underlying's ex-dividend date. So the buyer found it to be more profitable to exercise and, literally sacrifice the extrinsic value that's left on that option in order to collect that dividend because the dividend outweighs it. So, if they're sacrificing $10 in extrinsic value, but the dividend is going to pay $12.50, they're like, oh, cool, I'm gonna hit that button. That's why. So really just be sure to pay attention. Like if you're around the ex-dividend date, let things cool off a little bit. You know what I'm saying? There's no problem. Let that pass. And then as soon as it's over, I mean, you're good to go. Now, step 4, right? We got assigned. We're like, oh my God, I'm sick to my stomach, palms sweaty, mom spaghetti. I don't know what to do. Well, it's time to sell some covered calls. That's what we got to do. So now that you ran into scenario 2, you got 100 shares of a stock that you like. You're like, you know, everything's going to be all right. It's time to sell some calls. So ideally, you're going to sell a contract with a shorter expiration date. Some people like weekly, some people like monthlies. It's potato to me. It depends on, you know, your risk profile and you know, what your, how should I say? Yeah, just your risk profile, whatever you're inclined to do. And it's really, it's all immaterial. You're going to make money either way if you're trading it the right way, right? With weeklies, you could potentially profit more because you have 4 opportunities to lock in premium, right? So you're not stuck with just, say, in this example here, I said collecting $200 once each week for 4 weeks, which is a month, versus, you know, maybe monthlies are worth $650 and you go with something a little bit further out of the money. It's all the same. And this is assuming that each time that you sold it, you were collecting $200, which it is never like that, really. You're going to say maybe 200 one week, maybe 150 the next, maybe 100 the week after, and then maybe 300 the week after that. You just don't know. Like, premiums are always moving. That's why I have a tendency with my covered calls, especially with, you know, violent bull markets like what we've seen since October. I don't want to lock it in for too long, because if I really do like the shares, like, I don't mind just riding the wave to the upside and, you know, giving myself the opportunity to get that equity play. But yeah, so the premium that you collect each week is going to reduce your cost basis on those shares, right? So remember, we talked about you're assigned those 100 shares and you have a cost basis on them. Every time that you're collecting that premium, it's like taking money off the table a little bit at a time and a little bit at a time and a little bit at a time, right? So what was you being in this previous example right here, right, where we talked about example A, $90 loss that you would be incurring. So if we were experiencing a $90 loss after the assignment on that $61 NEO put, and let's pretend that we collected no premium beforehand, if we sold a 70, swap it, I'm going to scroll through it real quick. Boom, 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 boom. All right, A, B, covered call time. So I don't remember the last thing I said, but I know what bullet point that was on. So remember in the previous example here, right, I showed that we had the $61 put if we got assigned on it for NEO, and the shares are trading at $60.10. That's a $90 discrepancy, right? We're going to be down $90, assuming we never collected a single dollar in premium at all, right? Well, if we sold a $75 weekly covered call for $80 worth of premium, we would take that $90 loss and our cost basis would be reduced by $80. So we would net only be down $10 on our position. So with covered calls, we know that there will only be one of 2 possible scenarios that happen. And this brings us to the final step here, the final slide. Scenario 1, we sell an out-of-the-money covered call that sits at a higher strike than the price we paid per share. So if it expires out of the money, then you keep 100% of the premium that you were paid in order to open that position up, and the contract expires worthless. You're no longer obligated to do anything, and we pick out Rolls-Royce Interior. Or scenario number 2, of course, you sell an out-of-the-money covered call, and the stock soars above your strike price. You get assigned, and you must sell your shares at the strike price that you chose, right? So because you sold the covered calls at a higher strike price than what you paid, which we'll talk about in just a second, you would actually benefit. You would actually profit $1,400 on those shares if you sold that $75 call. So you'll need to collect as much premium as possible selling your cash secured puts in order to reduce your cost basis, right? And if you collect enough premium over time through your covered calls or through both your covered calls and cash secured puts, you can actually be net positive after your covered call gets assigned, even if you were less conservative in the strikes that you selected. Now, you're like, okay, well, that's great. I just learned how to sell a call. I learned how to sell a put. But what is why do people love it so much? And I know we're over time, so I'm going to make this as simple as possible. If you play your cards right and you sell your calls at a strike price that's greater than the price that you picked up your shares at, right? And it gets called away, even though you're missing out on the extra upside, right? So in the example that we chose, we sold a $75 call. We picked up shares at 61. Maybe let's say the stock goes to 80. You're only going to lock in up to that 75 strike, all that premium up to that 75 strike. However, right, net, because you sold at a strike that's greater than what you picked up the shares for, no matter what, you're going to be able to profit. Like, it just makes sense. You bought them at 61, you sell them at 75, you made a profit. You sell them at 74, you're going to make a profit. 73, 72, 71, 70, the whole way down. If you are playing your cards right and you are selling these calls, if it does get, your shares get called away, right? Because when you sell a call, you're obligated to fork up your shares, right? Because inherently, when you think about options, you're a buyer because you're buying calls, because if you were to exercise them, you're getting them at a cheaper than market value, right? You're getting the shares for $100 when they're trading at 150. That's why it's in the money. It's the same concept. When you sold that call and the stock shot up over it, people are wanting to buy the $75 shares when the stock is trading at 80. So you just have to think of things kind of flipped. But that's why you play your cards right, and you can exit each time you run the wheel for a profit. And that's the real juice. That's the real sauce that everybody loves about the wheel. It's all about collecting premium, collecting premium, collecting premium. And by the time that things get called away, you're in good shape. So scenario number one is ideal. And this is the visual that you guys have been waiting for. So it starts off, you sell a put, collect that premium. If you get assigned, then you have to buy the stock, and you're going to be down a little bit, right? But you're going to start selling calls against those shares, covered calls, right? Because you have 100 shares. And then eventually, if you get exercised, you're going to have to sell the stock, and you're going to profit because you chose a strike that was greater than the strike that you chose for your puts. And the wheel goes round and round and round and round, and you can keep doing it and building your account up until the cows come home. And that, my friends, is the wheel strategy.
This is wild.
Right? Right?
Yeah.
Yeah.
So I have a question for you.
Okay.
So when you go back in after you get called away on your shares,
Okay.
you go back in to sell the cash secured puts. What is your strategy? Are you still using that same stock? I know a lot of people use the same stocks repeatedly. What is your strategy for going back into the same wheel at the with cash secured puts at a higher price?
Yeah, so that's the thing. It all depends. It's going to vary, right? Because different companies, they'll go in different directions. You might have an earnings report where you're like, oh, they kind of updated and they're changing things around. I don't really see as much long-term bullish potential on this. It's not really something I want to hold. So I'm checking that investor relations page. I'm hawking it. But really, I have most of the time now, I'm more interested in put credit spreads more so than just selling cash secured puts and covered calls, just personally. But I have a handful of tickers that I'm they're mostly included in the S&P, but I'm looking at them to see where their charts are. And I'm like, okay, cool. We're approaching, a quarterly low. And every time that we've been here, we've bounced really sharply. I would not mind picking up shares at a lower price than what we're currently trading at. So I'm going to go ahead and open up my little, it'd be a put spread, but a cash secured put is the same thing as a put credit spread. It's just you're using an option contract as insurance instead of the actual underlying, which is what I'm going to teach y'all next session. So.
Yes, that would be great actually if you could show us how you actually execute your strategy. So starting from the very beginning. So you have a watch list. Maybe you use some scanner to find some high quality stocks. Maybe there are some scanners which also take into account any corporate events, any earnings dates, any ex-dividend dates, etc. So you do not get trapped by those events as well. If you do that, how do you sell a put? How much capital do you want to have first? How do you sell? How do you decide the size of your position? And do you sell 5 puts? Do you sell 5 puts? at once, or you say build your position. You sell you first sell, for example, one put, and next day you sell another put, etc., etc. For example,
Yeah.
what happens
Okay.
if the trade goes against you? Do you just have a hard stop, or do you watch delta? For example, if it starts moving to 50, do you buy back this put and sell the same put with lower strike again, for example? So how do you manage that, for example? And yeah, I know we can roll into later date, for example, if the trade is going against you. And do you track somehow? Do you have like Excel sheet or something like that? Which puts you are selling, how much premium you collected, what will be your price basis if you get assigned, for example, etc. And then you start selling covered calls, for example. So do you also track those commissions? Basically, in this case, you will see what will be real cost basis of your stock based on puts you sold and calls you also sold. Or for example, if you have some stock assigned, right? Do you start selling calls immediately? Because if you have stock assigned, that means stock is down. And if you start selling calls, there's a chance the stock will still go down, or there's a chance the stock will bounce and will go up. And so
These are really great
what's your thought process about it?
Okay,
Basically,
so
it's about execution end to end. Because what we have right now is just overview. What is selling put, what is selling call, etc. But I believe maybe it could be another call,
absolutely.
if possible, to show the execution. What technical analysis do you use? For example, do you use RSI? For example, do you look into stocks which are oversold, for example, to sell puts? And what time frames do you use, for example, to look at the stock? Or do you ever look at charts at all, or you just
Yeah.
you have your favorite list of stocks and you just sell puts and it's great.
And I will be sure to provide visuals. So I was writing down your questions as you were asking them, so my responses, so I can answer everything you just asked me. So number one, there's this guy on YouTube. His name is In the Money Adam. He has a spreadsheet specifically for the wheel. I'll drop his YouTube video in the trading chat after we hop off of here. But that it's a spreadsheet that's like fully done. Back whenever I was really like anal about tracking where every penny was, I was using that spreadsheet. Now at this point, a lot of like I understand the wheel to a degree where I'm like, I know exactly how much I collected. I know what's happening. So I don't have to like, track down to the very dollar what's going on in my portfolio. It's once you do the wheel a couple times, you've seen, pretty much anything that can happen, especially once you have your assignments hit on both sides. Once you've been assigned to put and assigned on a call, you know what to expect and nothing really catches you by surprise anymore. You knew what you were getting into. So In the Money Adam has a great Excel spreadsheet. I'll be sure to give that to you. I also like to use optionstrat.com to track and to show. So in the next session that I teach you guys about credit spreads and debit spreads, we'll go through OptionStrat and I'll show you everything that there is to know, how to set up trades, how I'm like gauging the probabilities and everything. The next question you said was like technicals. Are you actually using technical analysis or are you just using statistics? I've tried both. And now I'm trying to learn about the strat at this point because I'm like, okay, well, maybe if I just looked at price action, it would make more sense. But before, I was just using a combination of 4 different exponential and simple moving averages based off of like, I used the 5 and 10 exponential, the 20 and 200 simple. So why 5, 10, 20 and 200? How many trading days are there in a week, 2 weeks, a month? And the 200 is what institutions use for, determining is it's in a bull market or bear market. And there's a lot of orders that sit. Whenever you touch the 200-day moving average, you'll see volatility will pick up there. So I want to know where the 200 is relative to price action. But I'm being evangelized by ADEX. So now I'm trying this out with the strat and we shall see, if I can get with the program, because clearly this stuff works. So, yeah. Yeah.
I asked two questions.
Do you consider ATR at all?
You know what? I have considered ATR, but I don't use it on a day-to-day basis. And I know plenty of people though who do use ATR, and it's super. And what the weekly expected move that I don't know. There's a guy, Traders Retreat. I don't know if y'all know him on Twitter, but he likes to use the like weekly expected move and things like that. I don't use it, but it's super nice to know.
Okay.
Mm-hmm.
If you're selling a covered call that's super out of the money,
Mm-hmm.
Do you only collect premium if someone actually purchases it from you? So like if a stock is trading for $5, but you sell a $100 strike.
Mm-hmm. So you would collect premium the moment that it gets open. So the moment that you think about the bid-ask spread kind of flipped on its head when it comes to being an option seller, right? You want to be able to collect as much premium as possible, but buyers want to pay as little as possible, right? So number one, on a $5 stock, if you're selling $100 or the 100 strike, you're not going to really make it. It'd be worth $1, if even that much, if there's even any liquidity that's up there. But I know that this is a hypothetical. So no matter where you are on the options chain, as long as you smack the bid at some point, or if somebody's coming up and smacking the ask and you're getting the full amount that you're looking for, right? Let's say, you wanted $100 in premium. The bid is chilling over at, 90. And then the stock moves and now the bid jumps up to 100 where you are. You're going to get tagged in, right? There's going to be a buyer there that's wanting to snap it up. You're locked into the trade at that moment. And the only way for you to be out of the trade, like I said, is just to buy it back to close. But yeah.
So someone actually has to purchase it.
Yes, someone has to. And you'll know when it happens because it's going to show up. It looks the exact same as if you were buying an option. It's all the same.
Okay.
It'll just say
negative
one. Mm-hmm. Sorry. No, you're good. Go ahead.
The second question I have is, it seems like it's a fairly foolproof plan if you play it right. What are some common mistakes that folks make?
Dividend dates. Yeah, ex-dividend date is really the major mistake that is most common and that turns people off from the wheel. Also, selling calls at a strike that's below your acquisition cost, right? So if, like that example with the 61 strike put, we got assigned, so we got our shares at 61. Maybe the stock is just tumbling like crazy, and they're selling, a 45. Like, you're locking in. Essentially, what you're saying, whenever you start choosing strikes that are below your acquisition strike, is you're locking in a guaranteed loss unless you were able to collect enough premium where, so let's say you collected $1,000 in premium when you were selling puts, then you collected another $1,000 in premium selling calls over like a year, right? So you're up 2 racks on the trade, and, maybe the stock has fallen and you're down $1,000 on the stock. Net, you're up $1,000. That will give you some wiggle room to choose a strike that's below the strike that you initially acquired the shares at. But it sucks, right? Because let's say that things bounce back and then eventually, it goes up to $70 again. You're up the creek without a paddle. So those are the only 2 scenarios, and they're both like person errors. They're not like, the process itself works. It's effective, but it's just human user error. Not checking for ex-dividend dates, not being smart with your strike selection. But typically, if you're sticking to the rule of thumb with that 0.3 to 0.2 delta, and it's actually a company that's performing well, their stock price is appreciating, or even if they're just trading kind of in a range, you're going to be okay. Like, you'll be fine. You just have to make sure you're paying attention to where you're at on the chain.
Thank you.
Yeah, no problem. Great questions. Yeah. D, all of the above. Literally all of the above. Like, people don't know. when you first get started trading options, like there's some of the people that were like, oh, I accidentally pressed a button and I sold to open this call instead of buying it. And everybody's like, oh my God, you're going to lose infinity dollars. You're going to owe 30 million, billion, trillion dollars. And so people freak out and they're like, I'm never selling options ever again. Or they don't have a grasp on the Greeks. And so if you don't know how the Greeks work, then you're never going to be able to understand what it looks like from the seller perspective, because you're never going to think like a seller. But it's a lack of knowledge. It's kind of a fear thing. And, if you don't know what's going on and you're afraid of it, you're never going to touch it. But this opens up, this is like taking a limitless pill, y'all. Like once you understand how to sell options, Wall Street bets, think about all those people that go in there and they blow millions of dollars just gambling, trading dumb, buying a 10 delta 0 day to expiration and saying, I'm buying a Lambo tomorrow just for it to get you just eviscerated. Those people are the people that are trying to buy those options with a 15 delta, a 20 delta, and hold it all the way till expiration. So you just play, you're like the house, you're the casino. You know what I'm saying? You're doling them out. If they're buying, you're selling. But yeah. Mm-hmm.
A question and follow up to that. It seems like you also have to have at least a medium-sized account to do this. You have to have enough capital to buy the stock. So how do you manage this if you're working with a smaller account?
Oh my goodness. I love that you just asked this, because this is the perfect segue to get you excited for my next lesson where I teach you guys about credit spreads. So in this example, the reason why I start you off with learning the wheel is because it is expensive and you're like, oh man, well, what is a way that I could make this affordable? And the secret sauce is a put and a call credit spread is the exact same thing as a cash secured put or a covered call. The only difference is instead of having to come up with thousands of dollars of collateral, you only have to purchase the next strike up or 2 strikes up or 2 strikes down, depending on if you're talking about calls or puts. And essentially you're using an option that you're buying as the insurance. So you're financing, you're getting paid to play, kind of like you're collecting. Let's say that you sold to open an option and it was worth $500, right? From that $500 that you were paid, you can actually use that money to purchase a call that's worth $200. And now you're selling a put that was worth $500, but you're only going to get to collect $300, but it's still the exact same thing. So when we start talking about put credit spreads and call credit spreads, it is literally the exact same thing as selling a cash secured put or a covered call. The only difference is instead of us collecting the full amount of premium and having thousands of dollars of collateral locked up, we're just going to spend a portion of what we collected to purchase that option contract that's slightly further out of the money and use that as our insurance policy.
And you don't have to own the shares.
Right.
You said it, but I guess because obviously you know your stuff 1,000%. Like you know it better than I do. Obviously, 10x. but I guess no. People like her that wanted to know for small accounts, you don't have to have the shares. That she just emphasized it. You don't have to have those thousands of dollars. You're not tying up to shares itself. You're just using the other side of the option, whether it's a call or put, to buy and sell. In the case of a credit spread, hypothetically, then you don't have to own. I don't know. Let's just use Rivian, $9, right? Mm-hmm. Rivian right now is $9. You don't have to have 100 shares of Rivian. Mm-hmm. You can just use the credit spread to still play the same way, but you're not going to maximize like what you said. Yeah. Sorry.
Yeah.
Correct.
Exactly. That's exactly what it is. And so now imagine, right? What's a better trade for a small account? Tying up $7,000 in collateral to collect, $500, or tying up $500 in collateral to make $200. You see what I'm saying? So I'm going to teach you guys how to reduce the collateral that you need. And in my opinion, this is a kind of bold claim, but I'm willing to go toe to toe with anybody on it. If you're a small account and you're not liking to sit down and, you can't, or you just can't sit down, you work a 9 to 5 and you still want to be able to trade, man, this is a phenomenal way to help you get to your first 10 or your first $25,000, building, just because you're getting paid in time. Time is the only constant that has been the exact same in the stock market since the first bell opened for things to be traded. Time is the only constant. So put it on your side. And that's why we're going to get into credit spreads right after this. Reduce the capital and sit there and chill, and you're good. As long as you're out of the money at expiration, you're going to make 100% profit, and you can ride off into the sunset and pick your Rolls Royce interior.
I'm ready to pick Rolls Royce interior.
I love
that you say that.
Me too, girl. I'm trying to pick it out with you. I'm trying to pick it out.
Thank you.
So the next session, you're not going to keep us hanging until next month, right? Next week?
Listen, I'm down. I literally am doing this full time, just trading, and I'm in the Discord every single day. I'm just like lurking, and I'm kind of quiet off to myself, but I love it. If you guys want, I will show up anytime, any day. I'll block off my schedule. Not that I have anything going on, because I'm literally just trading all day, every day.
I was only kidding. Wow. Okay.
No, I dead ass. I will do it. I will do it. I have so much fun talking to you guys. Y'all are such an amazing group of people, and y'all are so smart. So why wouldn't I want to?
Thank you. I mean, honestly, like credit spreads has been my weakness. So debit spreads my strength. Credit spreads my weakness. Just a little bit afraid. I got stung twice, so I just left it alone. But
yeah, don't worry. We'll fix that right up. Don't worry.
Yeah.
Oh, I cannot wait to show you guys everything in the bag of tricks. We're gonna start talking about. So I'm thinking next session we go over credit spreads. Then the session after that, if you want, we can tag team debit spreads. That would be really dope. I would love to like tag team it, and then. From debit spreads, we can go talk about horizontals, how to make money when the market is kind of sideways and chopping, and then diagonals, because I know that there's some warriors in here who have leaps, and I'm like, you could be making passive income off of your leaps every single week, and you don't even realize it.
Yep.
People leaving thousands on the table.
Yep.
All right.
Absolutely. He's saying Rolls Royce and Sunset, dude. Like, I'm not gonna wait next month. I'm not gonna wait. Let's get it now.
Right. Tomahawk steaks, y'all. We're trying to get some tomahawks. But yeah, that's all I got for you guys today. I hope that y'all really, that it wasn't too boring. You didn't fall asleep sitting upright. And if you have any more questions, like I said, hit me anytime. I love talking about this stuff. It gives me breath and life in my body.
First of all, you're a great teacher, but you actually have charisma. Like, there's no way in hell. Like, I could sleep in a class. Like, everybody knows me. Just no, you had my full attention, and I'm one of the like I used to crash in school. So
oh, you're so sweet. Thanks, guys. Thank you. Thank you. Yeah, thank you. And if you have a Twitter, guys, at ADEX and at me, and say something that you learned today. I want to see what you guys picked up. If you were smelling what I'm stepping in, if you get what I'm saying. So I want to see. Just tweet me. My name on Twitter is The Wealth Hunter, at The Wealth Hunter, and then at ADEX. Because I want to show the world that we really did make some great knowledge was learned today in this Discord. So with that, I hope you guys have an awesome weekend. And we'll be back at it like we never left. What, tomorrow, ADEX, for a little watch list action? Oh, I love it. I love it. All right. Sweet. Thanks for everything, y'all. Peace.
Thank you.
Thank you so
Thank you,
much.
guys.
All right, thank you.
ADEX, somebody asked, when is the recording going to be available? Immediately. Okay.
Nice.
All right.
Because I came in late. Nice. Thank you, guys. Appreciate it, AX and Raven.
Yeah.
You're welcome. You too, guys.
Thank you. You too.